Right now, there's a massive, almost silent revolution happening in the world of finance, and it's a fundamental shift that's already changing everything, from the biggest corporations all the way down to your personal retirement savings.
So let's just start with this number, $41 trillion. That's trillion with a T. Now, this isn't just some abstract figure on a screen. It represents what is probably the single largest reallocation of capital in modern history. It's a tsunami of money on the move, and it's all heading toward a very specific deadline.
So, the huge question is, where is it all going? And maybe more importantly, why is this all happening right now? Well, that's the mystery we're going to unravel in this explainer. And the answer is changing the very foundation of how our economy gets funded.
To understand where all this money is flowing to, we first have to see where it's coming from. And that story starts with something people are calling the Great Bank Retreat. Basically, a huge pullback by traditional banks from their historical role as the main lenders to businesses.
So what caused this retreat? Well, you can trace it all back to the 2008 financial crisis. In the aftermath, a whole bunch of new laws were passed to make the banking system safer, and these rules essentially forced banks to hold on to way more cash reserves. That, in turn, made it much more expensive and a lot less profitable for them to give out long-term loans to businesses.
And this created a massive problem. As the banks pulled back, this giant credit gap opened up. All of a sudden, you've got all these healthy, growing companies that need money to expand, to hire people, to buy new equipment, but their bank, their traditional source of cash, was suddenly saying no a lot more often.
You know what they say? Nature abhors a vacuum. And into this huge gap stepped a brand new player. This is where our $41 trillion story really kicks into high gear. An entire system of non-bank lending, what we call private credit, has sprung up to become the new engine of corporate finance.
So, what is private credit? Well, put simply, it's when big investment firms, insurance companies, and even pension funds lend money directly to businesses. They completely bypass the traditional banking system. It's a direct line from these huge pools of money to the companies that need it to grow.
Let's look at the key differences, because they're pretty stark. A traditional bank loan? That can take months to approve, and it usually comes with really rigid one-size-fits-all rules. Private credit, on the other hand, can get done in just a few weeks. The terms are often custom-built or bespoke. They can structure payments around a company's unique cash flow, for instance. So what's the trade-off for all that speed and flexibility? You guessed it, higher interest rates.
So how does this actually work in practice? Well, it's a pretty straightforward process. First, a firm pools together a bunch of capital from huge investors. Think pension funds, the very source of many people's retirement savings. Next, they negotiate a custom loan directly with a company, and they often secure that loan against real physical assets like machinery or buildings. And here's a really critical detail. Most of these loans have floating rates. That means if market interest rates go up, so do the loan payments for that company.
Okay, so I know what you're thinking. Pension funds, custom loans, floating rates. This can all sound like really abstract, high finance stuff. But believe me, this shift has very real, very practical implications for businesses, for the economy, and yeah, even for your personal finances. And this brings us right back to that crucial deadline, 2026. So why that year specifically? Well, it's because a massive wall of older, pre-existing bank loans is all set to expire right around then. All of that debt needs to be refinanced, and the banks, for the most part, aren't taking it back. Instead, it's all migrating en masse over to the private credit market. That's the event that pushes the total value up toward that absolutely staggering $41 trillion figure.
All right, so let's break down the impact on everyone who has a stake in this. For businesses, it can mean easier and faster access to the money they need, but it's going to cost them more. For you, the investor, it means your retirement fund is almost certainly a direct lender to these companies now. For the economy as a whole, it actually creates a new channel for credit that can stay open even if the banks run into trouble. And what about the banks themselves? Well, their role is changing. They're becoming more like advisors and deal makers and less like long-term holders of debt.
This slide really maps out the new financial ecosystem. You've got your institutional investors, like pension funds, who are providing the cash. You have the lenders, like big asset managers, who loan that money out directly to the borrowing companies. The traditional banks are often still in the mix, but now they're acting more like middlemen. And all the while, you've got regulators trying to keep an eye on this much less transparent system.
But, of course, there's no such thing as a free lunch in finance. This new system, for all of its benefits, it comes with a whole new set of very serious risks. So let's take a look at what could go wrong here.
The first major risk is transparency, or really the lack of it.
Because these are all private deals, they happen in the shadows, totally outside of public view. This makes it incredibly difficult for regulators to get a clear picture of how much debt is actually building up in the system and, where all the risks are hiding.
The second risk is cost. Remember, that speed and flexibility we talked about comes at a price: higher interest rates. Now, this is great for investors who are looking for better returns, but it puts a much heavier burden on the companies doing the borrowing. If the economy slows down, those higher payments could become a real problem.
Third, we have something called illiquidity. This is a risk for the investors. Yep, those pension and retirement funds again. When they put money into a private credit fund, it's often locked up for years at a time. They can't just pull it out tomorrow if they need it. And this can create major problems if, say, they need to pay out a lot of benefits unexpectedly.
And that brings us to what might be the biggest concern of all: systemic risk. See, we've shifted a lot of risk out of the highly regulated banking system, but we haven't actually gotten rid of it. If a wave of these private loans starts to go bad, the losses won't hit a bank. They'll hit the retirement funds and insurance companies that millions of us depend on. In other words, a big downturn could directly impact the value of the very savings you are counting on for your future. It's a whole new pathway for financial trouble to spread.
So we're left with this fundamental question. Is this $41 trillion shift creating a more diverse, more resilient financial system? One that's no longer completely dependent on just the banks? Or are we just building the world's next great financial blind spot, creating new, hidden risks that we won't fully understand until it's way too late? The answer? Well, it's probably going to define the next decade of our economy.